Hello, everyone. Welcome to Investment for Beginners. I'm Manuel Maurício. You can find all my work over at allinstocks.com. And with me, I have Michael Wiggins de Oliveira. How are you, Michael?
Hey, thank you very much, Manuel. So my name is Michael from Deep Value Returns on Seeking Alpha, where I talk to you about a premium newsletter for buying high quality, actionable investment insights. So what we're going to talk about today?
We're going to talk about breaking up big tech and what it can do to their stock prices. Everyone's nowadays thinks that the biggest challenge to face, mostly to Facebook, but to other companies as well, like Google, is the legislation breaking up their monopolistic position. And I've come across with an article by Matt Stoller, and I think this is how you properly pronounce his name. I'm sorry if I'm wrong. About examples of companies in the past who have been broken up, and which shareholders have come out at the end much better than they were before. And not only shareholders, but the clients, the customers of these companies have come out pretty well at the end. And I'm going to talk about three of them really quick so we can discuss it afterwards. And I know that you, Michael, or you invest a lot in tech companies. So I wanted to have your opinion on this. So the first company that the author Matt Stoller talks about is Standard Oil by J.D. Rockefeller, at the time the richest guy in the world. And in 1911, the Supreme Court separated or broke up Standard Oil in 34 different companies. Some of them we still know today: Exxon, Mobil, Conoco, Chevron. And shareholders did pretty well with all of these companies. Rockefeller himself multiplied this fortune by 5 times. And the question is, why did it go so well for investors? First, and the article argues that the monopolistic structure that was there before was inefficient, right? So when they broke up, when these companies broke up, when Standard Oil broke up, it led to a lot of competition between themselves and other companies, and to innovation. And Matt gives the example of Indiana, which was a company that was spun off from Standard Oil. And Indiana, prior to the breaking up of the holding company, asked for $1 million from the headquarters to develop a gasoline refining process. And the administration, the management didn't grant the $1 million, but after the breaking up of the company in 34 smaller companies, they managed to get that $1 million. And at some point, investors who held on to Indiana stock were the best rewarded of all the 34 stocks, because they've developed the process to manufacture, to refine the gasoline, and then they licensed the process to all the other 33. So they came out pretty well at the end. Another example of this were the utilities, the American utilities in the 1930s that were opaque, really opaque holdings. There were a lot of assets moving around within the holding companies just to dodge taxes, and that there was a lot of shenanigans going on in the utilities in the 30s, and then they were dismembered, broken up. And a few years after, there was this congressman, Manuel that was mentioning on one of his quotes that from a total market cap for the utilities of 135 million in the 30s, in the 50s, the market cap was 4 times that amount. So the shareholders came out really good. And not only that, but the consumers' electricity prices went down exactly because of the competition that the legislation had created. And a more recent example, AT&T and IBM in the 70s. AT&T was broken up. IBM wasn't, because the people breaking up AT&T thought that one of the spin-outs of AT&T would compete with IBM, would go on and compete with IBM. So they didn't need to break IBM into pieces, which is interesting, okay, an interesting rationale. And what we saw afterwards is that AT&T, with all the baby bells, the companies that were spun out of it, went on to have, or shareholders went on to have a great returns, whereas the IBM returns weren't that stellar. So the conclusion of this article is that breaking up the big tech companies, are breaking up big conglomerates or big monopolistic companies might actually be good, because how many startups or segments are inside Google. And he gives the example of one RSS feed that he bought or used, that was bought by Google, and because it didn't move the needle inside Google, it was like discontinued, or it was forgotten inside Google. And he argues that there must be a lot of engineers inside Google, Amazon, Facebook, whatever, and ideas that are just in the drawers, right? And if these companies were breaking up, they could our shareholders could benefit massively from that. I understand that, and we were talking about this previously off the air, about how I don't it was not off the air, but it was some episodes ago, how the Facebook benefits from having all of those properties, right? For having Instagram and the Blue app, and how Google benefits from having Google Maps and a bunch of and search and a bunch of other things. But I guess that there must be a lot of stuff, a lot of technology that, if it was released from these big companies, it could bring us quite good returns. So you, Michael, you you swim where these fishes are, what's your opinion on this?
Well, let me just say, Manuel, that's a very good introduction. Like, you really explained and laid down the foundation quite well. I mean, after listening to that introduction, I have so many different kind of ideas here. So the first one that I would highlight is that SpinOffs is traditionally Joe Greenblatt's territory. So this is like something that's well trodden. Everyone knows SpinOffs kind of should do well. That's the first thing. The second thing that I'm going to highlight is that I would be quite specific. So, for example, in the case of Amazon, Amazon has the consumer business and it has AWS, which is a cloud business. These are two very distinct businesses. And Amazon itself says, whoever goes with us on AWS, it's only AWS. We do not sell the data or anything to do with the data into our consumer side, so into our retail business. Those two are very, very separate. On the other side of the equation, you have something like Facebook. Man, that data is shared everything. Like, whatever you have on Facebook, man, that goes to WhatsApp, that goes to Insta, that goes to whatever you want to do. Like, they own that data. And the same with Alphabet, or the company of Google. So if you search, how can I get shoes close to me? Then you go on Maps. Guess what? The map is telling you, go here. So I think it's specific. Individual companies have different advantages. For example, in the case of Alphabet, there's a lot of advantage to sharing that data. I will just add one more thing within the case of Alphabet. If you go yourself and you type on, let's say on Google, to check out like a podcast about investing. Nowadays, in the past, up to let's say a year ago, it would have been just basically look on YouTube, look on YouTube, look on YouTube, look on YouTube. Nowadays, there's so many different options that magically surface. It's not that those algorithms have become stronger. It's just that Google's trying to say, hey, we're not like so monopolistic. Don't think about us anymore. Like, we don't have all that data. Look at Vimeo, look at Bing, look at like, they kind of like, you know, everyone knows that it's not, but they're saying that, so they're already preparing for this possibility already. So I think it's very much specific. And what I would also say is that looking in hindsight, at the case of, let's say, of Standard Oil being split up, the oil industry has been in such a boom anyway. So it probably would have been 5x anyway, just because of the natural tailwind anyway. And it's that kind of correlation is not necessarily causation. So it's kind of sometimes it's like that, right? You kind of look at something and in hindsight, and you build a narrative. That's what we discussed in the previous episodes. You can add whatever adjective when you want the share price is going up. And in the case of IBM, you can say, oh, well, it didn't get split up, therefore it's not a great business. Of course, IBM like hasn't done very well. Everyone knows that. Buffett knows that better than anyone else. And if you think about it, right, it is a big business, but how many businesses stay around for more than 50 years? It's very, very difficult to have been relevant in the 50s and 60s and still to be relevant in 2021. So it's difficult. That's just how business, that's capitalism. And, there's always going to be some other business going to churn out. And even Jeff Bezos himself says that at some point in the future, we are 30 years into our history, and in some point in the future, Amazon is going to be bankrupt. So,
yeah.
that's just the natural course. And yeah, yes, sorry.
No.
I was just going to say that these things are difficult. And I think that in certain cases, like if Amazon split up, man, I would be willing to bet that AWS would get meaningfully re-rated higher. And I don't think that the shareholders would kind of think twice about holding on to Amazon, but I don't know, we could make that discussion. But in the case of if Google split up, I think that the share price was just like, poof. I think that the shareholders would be very worried about that.
There's one thing in Amazon, which is AWS used to fund the retail business a lot, right?
Correct, yeah.
Amazon grew to where it is today because it had AWS, which was highly profitable, funding the retail business, which wasn't profitable for a long time. And then you've mentioned another thing, that you can look back and create the narrative as you wish, right? And that is true. And one thing that is also true with these three examples is that there's not that the sample is limited, right? There's not that many companies, that many monopolies that have been broken up by regulation. There are some, so we can extrapolate some things, but it's better to.
But I think that it's a well-known thing that the spin-offs typically do quite well, because ultimately it's the power of the incentive, right? You get a different CEO and they're very much motivated to drive, let's say, the spin-off company higher, and the other CEO that stays behind, they also want to show that they can grow faster. So you get two very competitive businesses that are not competing against each other, but just driving forward. So typically, it would get, I suspect, but the history shows you, like if you do spin-offs, you can look at this countless case studies looking at spin-offs. So typically, I think that it's right, but I think that specifically within tech companies, specifically within Google and Facebook, in these instances, I think there's a lot of cross-pollination of that data. So I think that in that case specifically, I don't think that they would do particularly well. But these guys have been innovating like magicians, right? So who knows, right?
While I was reading this article, I was one part that I've left out was that AT&T, prior to being broken up, had a plan. If that were to happen, how would they proceed? How would they react? What was the plan? They had a plan. And I think about this a lot. Does Mark Zuckerberg have a plan if they're forced to separate all the businesses? And I would bet that he has it.
I would bet. So I don't really know. So off the top of my mind, I think that Facebook is approximately 850 billion. I would say it's around about that. I haven't checked the market cap, but I think it'll be around about that. And if you think about it, there are teams of people in there that are probably, that's their job. Their job, Monday to Friday, 9 to 5, is to come in and think about how, once it gets broken up in the antitrust, how they're going to do, I think that's just like the ongoing business. I think that's just their job. The whole 20 team, like 20 floors of whatever, of headquarters, is just thinking about that. It's not just down to one guy. And that's the thing that it's a bit of a segue, but I just think that a lot of people kind of build a narrative around the CEO. You and I have discussed this in the past. So everyone thinks that Elon Musk is like X, Y, and Z. And then you look at, let's say, like he gets a lot of credit. And then you look at someone, let's say, like like Jack Dorsey is CEO of Square and Facebook, and he doesn't get any credit. Sorry, I apologize. Square and Twitter, and he gets no credit. And it's like
no credit mostly because Twitter could be a money printing machine like Facebook, and it isn't.
Well, it does print a significant amount of free cash flow. It doesn't get rewarded, but he is a relatively youngish CEO having two companies that are, one which is Twitter, 50 billion, and the other one, Square, is 100 and something change billion. So he has two different companies, right, that are like multi-billion. So, and he gets absolutely no credit. So like sometimes the media likes to build these stories around certain individuals, and they don't actually give enough credit. This is still a relatively young guy, Jack Dorsey, if you excuse his beard. He's clearly a very talented engineer, executive, whatever you want to call him. So it's interesting. These things that we kind of build, these stories that we build, and it's just fascinating me. But going back to your point about the spin-offs, I just think that when looking at a spin-off, there's that kind of initial reaction here that what the market doesn't like is the uncertainty. Like once the spin-off is announced that your company is going to split up, investors don't like that because you've been used to having this large company that's growing at a certain rate. You can put your little earnings per share, analysts can follow it. Everyone's kind of very familiar with the story. And then you kind of throw a spanner in there and you say, okay, over the next 6 months, we're going to split off and our revenues are going to half. And everyone's like, oh my God, what's happening here? Like, and even if you're like, okay, you're going to get shares in that business and we're going to keep your shares in this business, people don't like that because they kind of build up a narrative. This is the business that I like, Facebook. It owns this, this, and that. It's very neatly and logical, fits in my mind. And I built up a narrative that I like. And when the business splits up, is that uncertainty. How is it going to grow? And what are the growth rates of this business? What's the growth rate of the legacy business? What are the margins? Oh, it's like people don't like that. And I've always made the case, anytime there is a bit of uncertainty, not often, but the market gets things very right often. But sometimes if you just dig around a little bit, sometimes something interesting happens. And I mean, it's not always the case that the market is wrong. Most of the time, the market is quite right. I'm quite a believer of that. I didn't used to be a believer of that, but the more I've kind of stuck around investing and stuff like that, I do give the market a lot of credit. And when in doubt, I actually say the market's probably right because it's a terrific machine. I gave you one more example. So Salesforce is the opposite of spinning off. Salesforce is a serial acquirer, just buying companies. And at the start, let's say back in, let's say 2009, 2010, it was trading at a quite extended multiple and it looked irrationally priced at that time. But if you fast forward more than 10 years, the market was quite right. It was a very large multiple. And even though the multiples come down a little bit, it aired on the right side of the equation. The trajectory was very much right. So it's just like these cases show up all the time that sometimes something looks so expensive and it doesn't seem very rational at that point in time. But you fast forward 5 years and actually the market actually wasn't too wrong. And these things that like the spin-offs, a bit of uncertainty, like people don't like that. But it's just, if you do a little bit of work, sometimes you can get a bit lucky in these things.
That's it. We reached the end of this episode.
Okay.
Very nice talking to you as always, Michael. See you next.
Thank you, Manuel. Thank you so much. See you guys. See you. Bye.